Nigeria's Debt Management Office is set to offer 150 billion naira in its monthly bond auction for today, while 14.6 billion naira will also be on offer at the Treasury Bills primary market auction. Meanwhile, Nigeria's headline inflation continued its upward trend, rising by 6 basis points to 12.40% in the month of May. Ajoke Adepoju is a Forex Trader at Access Bank. She joins me now as we discuss these developments. Thank you so much for joining me on the show today, Ajoke. Now, let's start with the inflation figures, and I'd like to get your thoughts on what you make of this month's reading, or last month's reading, rather.
Okay, Kenneth, for the inflation, like you said, that it rose to 12.4% in May 2020, the highest we've seen for over 2 years, which is about 0.06% higher than 12.34 recorded in April. We all know that this is resulting from the economic implication of the COVID-19 pandemic, as well as the persistent effects of the country's coronavirus lockdown restrictions. However, the implication we see here is that this further worsens the negative return on investment. But based on trend, this does not really impact the market. The market is moved by liquidity, and we can see that investors have funds to invest in the market. And given that investors have been investing in the market stop inflation, we do not see much impact in the market. However, we think that the market might be skewed towards short-term investment, pending when we see reversal in yield, as investors may not want to lock down their funds in long-term securities, given the current inflation and the real return on investment. So that's what I think regarding the increase in inflation. Hello?
All right, man. Let's understand that this week I see it's quite a very busy week. Looking at activity here, I understand that there's a the bond auction today and the primary market auction. I'd like to get your thoughts on this, your expectations from these activities today.
Okay, I will start with the bonds auction. For today, the bonds market, the bonds market has been relatively active. We've seen bullish demand by investors, and this was even evident in the Sukuk debit of about 162 billion. And we know that the Sukuk bond was oversubscribed by about 446%. However, they sold about 162 billion at 11.2%. So we think that this demand is still in the market, and then we know it will flow into the bond auction today. 150 billion is an offer, 40, 50, and 60 for the 2023, 2025, and 2015 reopening. So my expectations is a bit tricky, because there are two things. The market is moved by liquidity, like I said earlier. And the pattern that the market has displayed in recent times is one direction, which is bullish, like I mentioned. And it just signals that investors have liquidity to play around with. So what I think, on one hand, stock rates might come out lower. On the other hand, government needs to borrow to meet deficits. So they may think of increasing stock rates to accommodate more investors. But all things being equal, we expect yields to trade lower than the previous auction. Maybe we expect slight decline across all maturities. Maybe for the 5-year tenure, we expect to see yields come out at 8.9 and 9.2%. That's the 2023, 11.5 and 11.7 for the 2035, and 12.5 to 12.6 for the 2015. So these are our expectations for the bond auction. Right, and for the PMA, you want to say something?
Yeah, I want you to also speak on the PMA as well.
Okay. For the PMA,
yes, you can speak on the PMA.
You know the amount on offer. Okay. The amount on offer is pretty low, 14.6 billion, given that's what's maturing. Given the low supply, we expect to also see a decline in stop rate from where it came out the last auction. For the 91 day was about 2%, so we expect a decline to about 1.9%. For the 182, maybe around 2.3%, and 3.8 for the 364-day maturity. However, if the DMO wants to oversell than what is on offer, we expect them to still maintain the rate. But if they're sticking to what is on offer, 14.6 billion, we think that rate will go down across all maturities for the PMA.